Hi, before we get into the episode, here's a quick update. I have some great news for all premium subscribers of the Ken. You can now listen to all of our paywalled podcasts directly on Spotify. By the way, we at the Ken are the first organization in India to launch our premium shows on Spotify. And unlocking them is super easy. Open any logged episode of one of the Ken's podcasts on Spotify, tap the lock icon, link your Ken Premium account, and that's it. Takes about 30 seconds, maybe 20 if you're a pro tapper. After that, the entire library opens up to you. 2 by 2 zero shot, first principles, 90,000 hours, make India competitive again, everything. And if you want a step by step guide of how to do this, check out the link to a guide in the show notes below. Now, back to the episode. Eight years ago, Anil Rai Gupta had a dream. He is the managing director of Havells, an electrical products maker, and he wanted to get the company into every Indian household. This was why Havells acquired Lloyd, a consumer durables brand. In the September quarter, though, Havells' revenue grew by only 5%. The culprit behind this tiny jump? Lloyd. It makes up about a quarter of Havells' revenue, but its sales dropped by nearly 20%. Currently, Lloyd's warehouses are filled to the brim with unsold air conditioners. This is after an unusually short summer left units gathering dust. It only gets worse from here. The Bureau of Energy Efficiency, or BEE, has new energy efficiency rules kicking in January 2026. So, the pressure to clear out old stock before the rules take effect is going to drive up costs. This drag isn't exactly new. Over the past 5 years, Havells shares have risen at just over half the rate of the BSE Consumer Durables Index. It didn't start this way. For a few years after the acquisition, Lloyd delivered. It brought scale, brand recognition, and a foothold in India's fast growing AC market. Revenues doubled to more than 20,000 crore rupees in just 6 years. But that growth came at a steep cost. Lloyd relied heavily on discounts for consumers and incentives for distributors. This was confirmed by multiple dealerships across Delhi, Uttar Pradesh, and Haryana. Soon, Lloyd became a cash heavy unit. Its operating margin collapsed from nearly 20% to about minus 7% in just 4 years. Operating margins, by the way, is the share of a company's revenue that's left after paying for its daily running costs. And this has kept Havells' overall profitability under continuous pressure. Meanwhile, competitors like Blue Star and Voltas were growing quite sustainably while keeping their margins in check. So here's the irony. In India's price sensitive consumer electronics market, Lloyd is the third largest air conditioner brand. But it already held that position when Havells bought it. And since then, as of March 2025, the capital Havells has spent on Lloyd has ballooned to over 3,000 crore rupees. That's actually more than all other Havells verticals combined. Still, Lloyd has ended up exactly where it started. What could be behind this lack of profitability is the depreciation of Lloyd's fixed assets. And in the process of this depreciation, its margins have been left vulnerable to every little shift in temperature or regulation. Welcome to Daybreak, a business podcast from the Ken. I'm your host, Rachel Verghese, and every day of the week, my co-host Snigdha Sharma and I will bring you one news story that is worth understanding and worth your time. Today is Wednesday, the 26th of November. The inventory pileup for Lloyd started early this fiscal year. Anil Rai Gupta, the managing director we mentioned earlier, addressed this in an earnings call last month. He said that this was the reason why production levels of AC units were scaled down. So here's what happened. In July, the Bureau of Energy Efficiency published updated regulations for labeling appliances, including air conditioners. These rules take effect in January 2026. Companies won't be able to sell old rated ACs to distributors after that. This made Lloyd's average number of days to clear inventory increase by nearly 10 days. But here's the thing, revisions to energy efficiency rules happen periodically. Consumer durable companies know this well. So, how did Lloyd end up with a load of old rated stock? The BEE announced the latest rating renewals last year. They were supposed to kick in from January this year. But the industry demanded a year's extension to manage inventory and align production standards. An unexpectedly weak sales season, though, wasn't something they could predict. Beyond the weak summer, the GST rate cut in September delayed demand. The rate dropped by 10%, and this weighed down Lloyd's AC business and led to higher than usual inventory levels. In fact, Havells inventory in the September quarter hit nearly 5,000 crore rupees across segments. That's at least 20% higher than 6 months ago. Its competitor, Blue Star, noted in their earnings call that all players are carrying inventory. They said they would have preferred the time it takes to sell inventory to be 35 to 40 days. But unfortunately, it's more than 60 days now. Still, the company has seen a steady growth in its operating margin. On the other hand, Voltas did take a slight profitability hit, though it wasn't as bad as Lloyd's. In Lloyd's case, the company actually burned cash for 3 years before they finally turned a corner. The inventory mess has impacted volumes across the industry as well, except for Hire, which saw 5% growth. All others saw volumes drop by almost 15 to 30% compared to the year before. This includes LG, Lloyd, Blue Star, and Voltas. Havells seems optimistic though. They expect inventory within factories to return to normal by December. But a large dealer in Uttar Pradesh says that this happens often when the company dumps inventory on distributors and resorts to steep discounting. That also resulted in a 10% increase in the company's working capital costs in the June 2022 quarter. This was because they were relabeling goods and aligning with new manufacturing protocols that came with a revised energy rating. But that wasn't how Havel saw things playing out. Stay tuned. Hi, I'm pausing this episode to ask you a very quick question. What's your best AI prompt? One you're actually kind of proud of. It saves you time and it does exactly what you need it to do. Why do we ask? Well, let's be honest. There's a learning curve with AI, and most of us are still figuring it out. So, we are running a short survey to ask you to share your tried and tested hacks. You share your prompt, you get a chance to be featured in one of our episodes, and you get to hear from others like you. All the productive, efficient folks out there who are making AI work for them. The link is in the show notes. It will take you just 5 minutes. We can't wait to hear from you. Now, back to the episode. Havells acquired Lloyd in 2017 for 1,600 crore rupees. Back then, Havells had big dreams. The plan was to cement itself as a go-to for everything consumer electronics. A former Lloyd employee told the Ken that the company wanted to provide everything from wires to appliances to someone who's building a new home. To make that happen, the company went on an aggressive spending spree. In FY23 alone, it spent about 400 crore rupees on building an AC plant in Andhra Pradesh. Later, in mid 2024, it spent 60 crore rupees to increase capacity at this facility and build another one in Rajasthan. The company also splurged on advertising. It ran campaigns during the IPL or Indian Premier League and roped in high profile actors. In FY25 alone, it spent over 600 crore rupees on ads. That's over 60% more than before the pandemic. The result? Lloyd expanded. Its revenue nearly tripled to over 5,000 crore rupees in just 6 years by FY25. But that came at the cost of margins. Lloyd also went the extra mile for its dealer network. A former employee claimed the company would ensure dealers' spouses had enough money in their bank accounts to feel financially secure. This was a way for the company to deepen relationships with these dealers. The ex employee added that Lloyd is probably the only manufacturer offering medical insurance to large dealers. These perks go above and beyond the routine incentives like foreign trips or big commissions. Lloyd was also among the most aggressive companies in terms of dealer outreach. It pushed products at discounted rates and incentivized wholesalers heavily until about 2 to 3 years ago. This strategy worked. Havells almost doubled its dealer network across segments to about 20,000 between FY22 and FY25. Still, Lloyd's market share in the AC space is quite low, under 10% in fact, behind Voltas and Blue Star. But it remains an important mid premium brand. Its air conditioners cost at least 15 to 20% less than its peers. And although the company returned to profitability in FY25, Lloyd's turnaround remains fragile and growth assumptions are cautious. A Delhi based wholesaler told us that the company has dialed back its aggressive dealer outreach compared to the previous years. The impact of that shift may yet show up in numbers. Still, there's potential. Lloyd's brand recognition in the AC market could help Havells grow its other product lines. Lloyd also makes washing machines, refrigerators, and televisions, though its penetration in these segments remains much lower than in air conditioners. So, the challenge for Lloyd right now is to clear out its old stock and transition to the new energy efficiency regime without burning massive amounts of cash. The clock is ticking.
Daybreak is produced from the newsroom of the Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription offers daily long-form feature stories, newsletters, and a whole bunch of premium podcasts. To subscribe, head to theken.com and click on the red subscribe button on the top of the Ken website. Today's episode was hosted and produced by my colleague Rachel Varghese and edited by Rajiv Sien.